All right, now we are going to discuss which things should not be capitalized within the cost of the property, plant, and equipment. So the rule is that initial purchase price plus any directly attributable cost that is necessary to bring the asset in the working condition should be capitalized. Now, if there's any indirect cost that is not directly associated with this asset, indirect cost, past cost, sunk cost, already committed cost, etc., should not be capitalized. Any indirect cost, which includes any past cost, sunk cost, already committed cost, such as you have the administration cost, it is going to be incurred irrespective of the asset being constructed or the asset being purchased, such as the general overheads, the fixed overheads, which are going to incur irrespective of the asset being purchased. So that is not associated with directly with that is not associated directly with the purchase of the asset. Similarly, you have startup or similar pre-production cost. For example, the training cost. Like you have purchased an asset, and now you're training your employees how to deal with that asset. That training cost should not be capitalized. Initial operating losses before the asset reaches the planned performance. Now, for example, you're expecting asset to produce 1,000 units, and it is not reaching that desired level right now, and you're having operating losses initially. Those initial operating losses should not be capitalized as well. Similarly, we have the refundable duties. The duties which are going to be refunded later should not be capitalized. So when we say should not be capitalized, then that means all of these will be recognized as an expense. And when we say it should be recognized as an expense, then the double entry is going to be debit profit or loss. Remember, when we say debit profit or loss, the profit or loss means the statement of profit or loss. When we are debiting it, that means either we are charging expense or the loss, and credit cash. So debit profit or loss, credit cash, this is the entry when we are expensing out these things. So we know that initial purchase price plus any directly attributable cost to bring the asset in the working condition, we have already discussed those things, should be capitalized. And these are the things right in front of you, which includes administration and general overheads, startup and similar production, pre-production costs, for example, the training cost, initial operating losses. These should not be capitalized, and these will be expensed out rather. So now we have an example. An entity started construction on a building for its own use on 1st April 2007 and incurred the following cost. So they're constructing their own asset. Okay, the rule is the same, the principle is the same. Initial purchase price plus any directly attributable cost to bring the asset in the working condition, and we are not going to capitalize any indirect cost, sunk cost, already committed cost, fixed cost. So an entity started construction. Okay, so the purchase price of the land, okay, it is going to be capitalized. Stamp duty, yes. Legal fee, yes. Site preparation and clearance, yes. Materials, yes. Labors, yes. Architect fee, yes. General overheads, and we know we are not going to capitalize the general overhead, so you're going to exclude this thing. You're not going to capitalize this amount. But we have some additional information in this question as well. The following information is also relevant. Materials cost were greater than anticipated. On investigation, it was found that materials costing $10 million had been spoiled and therefore wasted, and a further 15 million was incurred as a result of the faulty design work. Now the material is 100,000. Material is 100,000. Now out of these 100,000, 10 million had been spoiled. So the spoiled material should not be capitalized. So you are going to reverse this figure, minus 10,000. and therefore wasted, and a further 15 million was incurred as a result of the faulty design work. So the additional 15 million was incurred due to the faulty design work. Now it's your own mistake, so this should not be capitalized as well. So you're going to deduct this 15,000 as well. Now 100,000 minus 25,000, the rest is going to be capitalized. So you're not going to capitalize the material which has been spoiled, and you are not going to capitalize the material which was incurred as a result of the faulty design work, because it was your own mistake. So if you keep on doing the mistakes, you cannot capitalize all those mistakes and errors and operating losses. Okay, as a result of these problems, the work on the building ceased for a fortnight during October, and it is estimated that approximately 9 million of the labor costs relate to this period. So you have the labor of 1,50,000, and the labor was idle for 15 days. So you're going to deduct that 9,000, and the rest will be capitalized. The building was completed on 1st July and occupied on 1st September 20x8. So what amount should be capitalized? We are going to capitalize the purchase price of land. We are going to capitalize stamp duty, legal fees, site preparation claims, but material we are going to deduct 25,000, which was 15 plus 10. We are going to deduct the labor because the labor was idle, so that is not relevant to the cost of the asset. And then architect fee, general overhead should not be capitalized. So this 5,19,000. Now, what is going to be the double entry? Debit asset, how much we are going to capitalize? 5,19,000. How much the total payment has been made? Credit cash, 5,83,000. Now, this debit and credit are not equal. There's a difference on the debit side. That is the expense that we are going to charge. Debit profit or loss of 64,000. That is the figure which is going to be expensed out. So this is the figure which is going to be expensed out. And this is the figure which is being capitalized. All right, now we have the subsequent expenditure. And I told you earlier that either you are having the initial expenditure or the subsequent expenditure. It should meet the criteria of the asset. And hopefully you remember that the criteria of the asset, that there should be a resource which is being controlled by the entity, from which future economic benefits are probable and the cost can be reliably measured. So two main points are going to be future economic benefits and the cost can be reliably measured. So whether it is initial expenditure or subsequent expenditure, if you're going to capitalize it, it should meet the criteria of the asset. Now, the subsequent expenditure on property, plant, and equipment should only be capitalized. The first point is related to what you studied in your earlier accounting, that there are two types of the expenditure. The two types of expenditure, the revenue expenditure and the capital expenditure. So we studied earlier in the initial accounting paper that if you're spending on the acquisition, extension, enhancement, improvement, upgradation, etc. of the non-current asset, then this expenditure is going to be regarded as the capital expenditure. So any expenditure on the non-current asset which is related to its acquisition, purchase, extension, you are extending it. For example, you're having one warehouse and now you're extending it to another. You are having two warehouses. Enhancement, improvements, upgradation. For example, your machine was initially producing 1,000 units, and now you have done the expenditure on it, which resulted in more units being produced. Then this is the improvement, upgradation. So any expenditure on the non-current asset which is related to acquisition, extension, enhancement, improvement, upgradation is known as the capital expenditure. And capital expenditure is capitalized. And when we say capitalized, that means you record that thing as an asset. So debit cost, which is the asset, and credit cash. The revenue expenditure is when you have the day-to-day expenses. For example, when you talk about the purchase of inventory, it's the revenue expenditure because it's a day-to-day expense. Day-to-day expense. And similarly, when you have an expenditure on the non-current asset, which is related to the repair or maintenance. For example, we are going to paint our office building. Now, this is something related to the repair or maintenance. For example, we are having the service of our machinery. This is related to the repair or maintenance. When you talk about the revenue expenditure, a revenue expenditure is expensed out. So the first point is a subsequent expenditure on the property, plant, and equipment should be capitalized. And when we say capitalized, that means we're going to make that thing part of the cost of the asset. If it enhances the economic benefits provided by the asset, this could be extending the useful life of the asset and expansion or increasing the productivity of the asset. That means anything which is related to acquisition, extension, enhancement, improvement, upgradation, etc., which is known as the capital expenditure. So if you're doing the capital expenditure, that means it is going to be capitalized. Now, the second point is very important point. It relates to an overhaul or required major inspection of the asset. The costs associated with this should be capitalized and depreciated over time until the next overhaul or safety inspection. Now, for example, you are having any asset. Let's assume you're having airplanes. Let's assume you're having the airplanes. Or for example, you're having assembly lines, which are being used for the productions. Airplanes, let's assume. And you're going to have the overhaul of your plane after certain number of years, or it can be anything. For example, after certain number of flying overs. Now let's take an example. So you're going to overhaul your asset after a certain number of years. For example, your assembly lines. You're going to overhaul. Overhaul means, for example, someone will be coming. There will be a full team, and they will be doing the service and everything of all your assets, and it will be a complete overhaul. They will be checking each and everything of your complete assembly lines. That is known as the overhaul. It's a complete checkup, you can say, major inspection, complete checkup of the complete production facility. So you're doing the major overhaul or the major inspection after every 3 years. Now you are not going to expense out this thing immediately. Instead, the standard says that you're going to capitalize that overhauling cost or the major inspection cost, and you are going to depreciate that thing on the overhaul period. Now this makes a complete sense. Like the matching concept. What does the matching concept say? It says that income and expenses should be matched. So when you're doing the overhauling expenditure, you will be taking the benefit for 3 years. So why expensing that particular expenditure on a single year? It should be depreciated over the 3 years. Income and expenses should be matched. You will be using that asset for 3 years. You will be recording the income from that asset for 3 years. Why expensing out that major inspection cost over the 1 year? So it does not make any sense. So the standard says that if you are doing any expenditure on the overhaul, such as expense on the major inspection, the costs associated with that should be capitalized and depreciated over the time until the next overhaul or safety inspections. So for example, you are spending, let's assume 3 million, and it is for 3 years. So what you're going to do, initially you are going to capitalize this amount. The entry is going to be debit cost of the asset, credit cash, and then it is going to be depreciated $3 divided by 3 Every year we're going to depreciate it. So debit depreciation and credit accumulated depreciation, which is the double entry to record the depreciation. Now we are moving toward the third point. It is replacing a component of the complex asset. Now, what is complex asset? Complex asset is an asset where there are many components in it, and every component has a different useful life. For example, you talk about the plane. In the plane, there are engines, interior, exterior, wings, navigations. Everything is having a different useful life. Sometimes you see a plane and one time you're sitting, there's a different seating arrangement. Another time you're having a visit over on that, you see a different sitting arrangement. So they have changed the interior and the rest of the plane remains the same. So you cannot depreciate a single plane altogether because there are many components within the plane which is having a different useful life. For example, you talk about the engine, even there are multiple engines. And then you have the interior, then you have the exterior, then you have the wings, navigation. There are many things in it. Everything is having a different useful life. So that is known as the complex asset where there are many components and every component is having a different useful life. So if there is a complex asset and you're replacing a component of it, for example, you have a plane, Emirates, let's assume Emirates is having a plane. They are taking out the existing interior and they're placing a new, advanced, modern, comfortable interior in it. Now, when you're replacing a component of the complex asset, it is also a capital expenditure. It should be capitalized. But the condition for that is that the previous should be written off. And you are taking out the previous interior. You're going to write off that thing, remove that thing from the cost of the asset, and then you are going to place the new interior into the cost of the asset. So the condition is that you have to remove the previous and then you are able to capitalize the new one. So when you talk about the subsequent expenditure, there are three things. If it relates to the capital expenditure, enhancement, improvement, extension, it should be capitalized. If it relates to an overhauling, it should be capitalized and then depreciated over the overhauling period. And if it is related to the complex asset and you're replacing a component of the complex asset, then the criteria is that you should remove the previous component and then you are able to capitalize the new one. These three are going to be capitalized. Other than that, everything is going to be expensed out. And when we say the expensed out, that means debit, profit, or loss, and credit cash. And when we say capitalized, then debit, statement of financial position, that means debit, asset, credit, cash. So this is something related to the subsequent expenditure. Okay, now we have an example. A piece of machinery has an annual service costing of $10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units of product per hour. The cost of the replacement part is 20,000. Now, in this example, we have two expenditures. The first is the annual service. And remember, the service is usually done for the maintenance. So 10,000 should be recorded as the revenue expenditure and it is expensed out. So what is going to be the double entry? Debit, profit, or loss by 10,000 and credit cash by 10,000 because it is related to the annual service. Like we do the service of the cars, we do the service of the machinery, we do the service of the air conditions. So it is going to be expensed out because it is done for the maintenance. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units. So you're doing an expenditure. It is going to increase the efficiency of the asset. It is going to work faster and produce more units. So that means it is a capital expenditure and this should be capitalized. So the double entry is going to be debit asset. That means you're going to capitalize it by $20,000 and credit cash by $20,000. So the first expenditure should be expensed out because it's revenue expenditure related to the service, which is something related to the maintenance. And the second is increasing the efficiency of the asset, and also it is increasing the production. So it is regarded as the capital expenditure and it should be capitalized. Now we have the exchange of assets. Exchange of asset is known as barter. For example, you're taking one asset and giving another asset, or giving another asset and taking one asset. That is the exchange of asset known as the barter. So when you are exchanging the asset instead of buying it, for example, I'm giving one car and taking another. For example, I'm giving one machinery and taking another. How this transaction should be recorded. Now, the simplest way is whatever you are getting in exchange, you should measure the fair value of that asset. See the fair value of that asset, and whatever the fair value is, you are going to record the asset you are getting in exchange at its fair value. Unless the fair value cannot be determined reliably. If that is the case, then you are going to take the carrying amount of the asset which you are giving in exchange. Let's assume I'm getting a machinery in exchange and I can measure the fair value of it. So whatever the fair value of that machinery is, I'm going to capitalize the machinery which I'm getting at the fair value. But if it is not possible to determine the fair value of it, then at what amount I'm going to record that machinery? I'm going to record that machinery on the amount, the carrying amount of the asset which is being given up in exchange. For example, I am having machinery 1, I'm giving machinery 1 and getting machinery 2. So first of all, whatever the fair value of this machinery 2 is, should be capitalized. But for example, if it cannot be measured, then the last option is you take the carrying value of machinery 1 and similarly record machinery 2 at the same carrying value. This is known as the exchange of assets. I can read it for you. IAS 16 specifies that exchange of items, regardless of whether assets are similar, it can be different, are measured at fair value unless it lacks commercial substance or the fair value cannot be measured. If the acquired item is not measured at fair value, let's assume if it is not available, its cost is measured at carrying amount of the asset being given up. Whatever asset you are giving in exchange, take the same amount and record the new asset which you're getting in exchange at that particular amount. Now we are heading towards the depreciation, which is the most important concept of this standard. Now, before moving to the depreciation, I'm going to recall certain accounting concepts which you have studied in your earlier accounting papers. For example, the accruals concept. What does it say? It says that income and expenses should be recorded in the period to which they relate. No cash basis should be followed. Income and expenses should be recorded in the period to which they relate, irrespective of the cash being paid or received. This is known as the accruals concept. And then there was a prudence concept, which says the asset should not be overstated and liabilities should not be understated. Income is recorded when earned and loss is immediately recognized. Profit is recorded when earned and loss is immediately recognized. Full loss is immediately recognized. Because loss can never be unrealized, it is always realized. So accruals concept says that income and expenses should be recorded in the period to which they relate. Prudence concept says that the asset should not be overstated and liabilities should not be understated. And then there is another concept which is known as the matching concept. Now the matching concept says that income and expenses should be matched together. Now, what is the matching? Matching thing means, for example, if you're recording the income related to one asset, then you should record the related expense of that asset as well in the same year. For example, I'm having machinery, I'm using it for production. That production is being sold and it is recorded as revenue. So you're recording the income related to that asset. You should record the related expense of that asset in the same period as well. That is known as the matching concept. Now, when you talk about the depreciation, depreciation is simply the allocation of depreciable amount or allocation of the cost over its useful life. And it can be related to all of these three concepts. For example, I bought an asset for $100,000 and the useful life of that asset is 10 years. Now, if I keep this asset at $100,000 for the complete 10 years, then I am going to overstate the asset, because we know, generally speaking, that when we are using the asset, it loses its value systematically. For example, you buy, let's assume, LEDs for your office, and now 1 year has passed. Can you sell it in the same amount? Generally speaking, no, because you have used it for 1 year and the used thing is going to be sold for lesser amount in the market. Its efficiency will be lower. Its quality is going to be deteriorated, let's assume. So the general concept is, why I'm saying general, because there are some assets which can be appreciated later on. So I'm not talking about those appreciations. Generally speaking, when you talk about any asset, let's assume cars, when you're using it, if you're selling it after a year, then that is going to be regarded as a used car, and you are not able to sell it at the price of the new car. So whenever you are using that asset, any asset, with the use, it is losing its value. So for example, you bought an asset for $100,000 and the useful life is 10 years. So every year when you're using it, it is losing its value. So if you keep on recording that asset at $100,000 for the whole 10 years, then you are going to overstate the asset. And this is the misapplication of the prudence concept, because it says the asset should not be overstated. So that is why it says that you are going to record the depreciation. So you can say depreciation is the application of the prudence concept. Now, how it is related to the matching concept? When you bought an asset, let's assume the car for $100,000, and you're using it, let's assume, for the delivery purpose. It's a delivery van that you're going to deliver, that is delivering your products. So you're getting the benefit from it. Now, when you're recording the benefit from it in a year, then you should record the relevant expense of that asset in the same year as well. So if you're not recording the depreciation, that is going to be the misapplication of the matching concept as well, because you're only recording the revenue related to that asset and you are not recording the related expense. And it is also related to the accruals concept, that income and expense should be recorded in the period to which they relates. Now you're using the asset, the depreciation is an expense, so you should record that particular expense in the correct period to which it relates. So when you talk about the depreciation, it is an application of the accruals concept, because the expense should be recorded in the relevant year. It is an application of the prudence concept, because if you're not charging the depreciation, you are overstating the assets. It is an application of the matching concept, because if you are recording the revenue pertaining to those assets, you should record the related expense in the same year as well. This is known as the depreciation. So systematic allocation of the depreciable amount of an asset over its useful life. So if I bought an asset for $100,000 and the life is 10 years, then what I'm going to do, take the $100,000, divide by 10, and 10,000 per year, it is going to be the depreciation. Now, the double entry of the depreciation is debit depreciation. It is an expense which goes to the statement of profit or loss, and credit accumulated depreciation. Now, when we say accumulated depreciation, then that means we are accumulating the depreciation of every year. Accumulated depreciation account is being credited due to the depreciation, and then you get the closing balance of it. Next year, it is going to be an opening balance. Then you are going to add the depreciation of the next year. Then it is going to be a closing balance. Similarly, in the third year, it is going to be an opening balance, and it goes on for every year. Now, why we are making the accumulated depreciation account? Because when we have the accumulated depreciation, at any point in time, we will be able to calculate the carrying value. So with the help of accumulated depreciation account, we will be able to calculate the carrying value or carrying amount of the asset. So with the help of the accumulated depreciation account, we will be able to calculate the carrying amount of the carrying value of the asset. How it is calculated? You take the cost of the asset, you deduct the accumulated depreciation, and at any point in time, you will be able to calculate the carrying amount or carrying value. It is also known as the book value, the net book value or the book value, or you can also call it as the written down value. So why we are making an accumulated depreciation account? Because with the help of that, we will be able to calculate the carrying value and the carrying amount of the asset. And the nature of the accumulated depreciation is credit. Now, why it is credit? Because it is a reduction in the cost of an asset. So when we increase the asset, it is being shown as a debit. When we are decreasing the value of the asset, it is shown as credit. So accumulated depreciation decreases the value of the asset. That is why it has a credit nature. So depreciation is an accounting estimate. And this is one of the most important things that you need to understand. Depreciation is an accounting estimate. So we are saying that I have bought an asset that will work for 10 years. Now, when I say this asset is going to work for 10 years, it's my estimation. That is why depreciation is an accounting estimate. So there are two methods of the depreciation. Two methods of depreciation. This is known as the depreciation policy. When we say depreciation method, this is a depreciation policy. But remember one thing, that even when you are choosing between the straight line method and the reducing balance method, it is not your accounting policy, it is your accounting estimate. Even when you say straight line method or reducing balance method, still it is an accounting estimate. Now I'm going to explain it how this is an accounting estimate. So what is straight line method? Let's assume you bought a machinery that has a life of 5 years, and you have an estimation that this machinery will work for 5 years, and every year it is going to give the same efficiency. Every year it is going to produce the same number of units for 5 years. Now, if you are having an asset that will work same for the rest of its life, then usually what you do, you take the cost of their asset, you deduct the scrap value. Scrap value means the residual value. Residual value means the value at which this asset will be sold at the end of its useful life. So you take the cost, deduct its scrap value or residual value, and divide it by useful life. You get the depreciation per year. And we choose the straight line method for those assets which in our belief will work same for the rest of its life, almost same for the rest of its life. It is going to have the same efficiency, same productivity, same response for its complete useful life. And then we may have assets that will work more in the initial years and then will have the less efficiency in the later years. So accordingly, it should be depreciated more in the earlier years and less in the later years. Then we are going to choose the reducing balance method. In the reducing balance method, you take the cost of the asset and you multiply it by the depreciation percentage. You get the depreciation. This is for the first year. In the second and subsequent years, you're going to multiply this depreciation on the carrying value. Take the cost minus its accumulated depreciation, and then you multiply the depreciation percentage to get the depreciation of the second and the subsequent year. So remember one thing, that in the straight line method, depreciation is being charged on the cost. So make sure you are not doing this mistake in the exam. You're going to charge the depreciation in the straight line method on the cost, and in the reducing balance method, in the first year, it is going to be charged on the cost multiplied by the depreciation. In the second and subsequent years, it is going to be charged on the carrying amount, cost minus accumulated depreciation multiplied by the depreciation percentage. So either it's the straight line method or reducing balance method, or whatever method it is, machine over basis, flying over basis, number of digits method, whatever it is, the depreciation remains an accounting estimate, because you're thinking that your asset will last for certain number of years. You will be able to sell your asset at this amount after certain number of years. That is on the scrap value. You think your asset will work the same for its entire life. You think it will give more efficiency in earlier years and lesser in the later years. All of this is regarded as an accounting estimate. So important thing regarding the depreciation is that it is an accounting estimate. There will be two methods mainly within the exam. The straight line method, in which you are going to charge the depreciation on cost. In the reducing balance method, in the first year, it is going to be at the cost, and in the later years, it is going to be applied on the carrying amount. So depreciation is an application of all the concept, which includes accruals concept, prudence concept, matching concept. The double entry is debit depreciation. We charge that thing as an expense in the statement of profit or loss, and credit accumulated depreciation. Accumulated depreciation is an account in which we are accumulating the depreciation so that we are able to calculate the carrying value at any point in time. Now the question is, the depreciation is an accounting estimate. The depreciation is an accounting estimate. So depreciation method, useful life, scrap values, all of these are accounting estimate. So when it is an estimate, are we able to change it in the subsequent years? For example, if we feel that initially we decided the asset is going to last for 5 years, but now you have realized that this asset is going to last for 8 years, because even after using 2 years, the asset efficiency remains the same. And now you think that it is going to work for further 6 years. So are we able to change the useful life of the asset? Similarly, when you bought the asset, you initially realized that this asset will be sold at this much amount at the end of its useful life. Now the market value of that asset has been changed, and it can be sold for a handsome amount in the market. So can you change the scrap value? Can you change the depreciation method? Can you change the useful life? So the standard says yes. You can change the depreciation method. You can change even the useful life. You can change the scrap value only if there is a genuine change. Only if there is a genuine change. That means there should be a real change. It should not be done for the manipulation purpose, because management may do that for manipulating the profits, manipulating the assets. If it is a genuine change in the depreciation method, genuine change in the useful life, genuine change in the scrap value, you can change your accounting estimate. But the standard says that it should be done on the prospective basis. That means its impact is going to be in the future, and no past figures will be affected. You're not going to change the previous figures, which has already been recorded as a depreciation. So the standard says that IAS 16 requires the residual value, the useful life is reviewed at least each year financial year end together with the depreciation method applied to the asset. So see after every year whether there is a change in the depreciation method, whether there is a change in the useful life, whether there is a change in the scrap value. If there is a genuine change, you can apply that change. That is known as the change in accounting estimate, and that should be applied on the prospective basis. Prospective means future. So it cannot change the previous figure which has already been recorded. We have an example. An asset was purchased for $100,000 on 1st January 2005, and straight line depreciation. We know in the straight line depreciation we charge the depreciation on the cost. So life was 5 years, 100,000 divided by 5, it gives you 20,000 per annum. The annual review of the asset lives is undertaken for this particular asset. The remaining useful life as at 1st January 20x7 is 8 years. Now at 1st January 20x7, they realized that the remaining life of the asset is 8 years. Initially, they expected it to be 5 years. So that this was an accounting estimate. And later they realized that it should be more than that. So they can change their accounting estimate. Now, at what time they are changing their accounting estimate? At 1st January 2007. At 1st January 2007, 2 years has already been passed. So the carrying value of asset at 1st January 2007 or at 31st December 2006 is 60,000. 100,000 minus 2-year depreciation. Now the further depreciation should be charged on the remaining useful life. So you take 60,000 divide by 8 years. Now the new depreciation is going to be 7,500 per annum. Previously it was 20,000 per annum. So remember, the future depreciation will be changed and there will be no impact in the past figures. So that is known as the change in accounting estimate, which is applied prospectively.